Welcome to the deep dive. Ever wondered how the pros, the really sharp traders, seem to spot momentum shifts almost before they happen?
Or how they manage to ride those big trends.
Exactly. Well, if that sounds like something you want to get a handle on, you are definitely in the right place today. We're essentially giving you a shortcut, a way to get really informed about a key tool they use to get that edge.
And that tool, the focus for us today, is the MACD. That stands for Moving Average Convergence Divergence.
Right.
It's really a foundational indicator in technical analysis, super reliable, widely trusted. And the goal here is that by the end of this, you'll really get the mechanics.
Okay.
You'll know how to use it for different trading approaches, and crucially, how to combine it effectively with other indicators too.
So that's our mission then. We're going to unpack this powerful tool, pull out the most important bits from our sources, and sort of reveal the secrets, for spotting those momentum shifts before everyone else piles in.
Let's do it.
Okay, so let's unpack this. What exactly is MACD, at its heart?
At its core, it's a momentum indicator. It basically shows you the relationship between two different moving averages of a stock's price.
Okay, two averages.
Yep, it was developed way back in the late 1970s by Gerald Apple.
Wow, so it's been around.
Oh, yeah. And what's really fascinating, I think, is how it helps you identify those momentum shifts, like early. It gives you a heads up before it's super obvious just looking at the price chart.
An early warning system, kinda?
Pretty much, and that's why it's stuck around for so long, decades. It's simple, but it's effective, that combination.
Right, so it's not some, flash-in-the-pan indicator. It's got history. It's got staying power. And you mentioned it breaks down momentum. Using three key components.
That's right. Three main parts work together. You've got the MACD line, the signal line, and the histogram.
Okay, let's take those one by one. The MACD line.
So the MACD line itself, that's calculated by taking the 12-period exponential moving average, the EMA, and subtracting the 26-period EMA from it.
Exponential, right? Not simple.
Exactly, exponential. And the E is important. Unlike a simple moving average, an EMA gives more weight to the most recent prices.
Ah, okay, so it reacts faster.
Much faster. It makes the MACD line itself really responsive to what's happening now in the market. It directly shows you that current momentum, the oomph, basically.
Gotcha. Okay, so that's the MACD line. What about the signal line?
The signal line is, it's simpler in concept. It's just the 9-period EMA of the MACD line we just talked about.
So an average of the average difference.
Kind of, yeah. It acts like a smoother version of the MACD line. And here's the crucial part. When the faster MACD line crosses above this smoother signal line, that's generally your bullish signal. Upward momentum's potentially building.
And the opposite for bearish.
Yep. When the MACD line crosses below the signal line, that's typically seen as bearish, downward momentum might be taking hold.
Okay, MACD line, signal line.
Yeah.
And the third piece, the histogram.
Right, the histogram. This visualizes the difference between the MACD line and the signal line at any given point.
So it shows how far apart they are.
Oh, exactly. Its main job is to help you see when the MACD is gaining or losing strength. If the bars on the histogram are positive, above zero, and getting taller, upward momentum is accelerating.
Okay.
If they're negative, below zero, and getting taller or, longer downwards, downward momentum is picking up steam.
Interesting. So it's like each part gives you a slightly different angle on what the momentum is doing.
Precisely. Layered insights.
So how do these pieces actually, come together? What's the calculation, the logic behind it all? I know you touched on it, but let's clarify that.
Yeah, it's good to nail this down, and honestly, it's pretty straightforward, which is part of its appeal.
Yep.
The formulas are simple. MACD line, it was 12-period EMA minus 26-period EMA.
Got it.
Signal line, 9-period EMA of that MACD line.
Right.
And histogram, MACD line minus signal line.
Okay, simple math.
Yep. And remember, these EMAs are usually calculated based on the closing prices of the candles or bars on your chart.
And the logic. Why these specific numbers, 12, 26, 9?
That's a great question. Gerald Apple chose them, and while there isn't a single definitive paper explaining exactly why just those, the common understanding is they relate roughly to trading periods. 12 periods might be half a month, 26 a full month, and 9 maybe a week and a half of trading days.
Ah, interesting. So it captures different time frames within one indicator.
Yeah, it blends short-term responsiveness from the 12 EMA with a slightly longer-term view from the 26 EMA, and then the 9 smooths it out. It's a balance that seems to work well across different markets and time frames. It captures those medium-term cycles quite effectively.
So understanding that logic,
Right.
It helps you actually trust what you're seeing, right? It's not just lines crossing on a screen.
Exactly. If you connect this to the bigger picture, knowing why the lines are moving helps you filter the signals. You're not just blindly following. You understand the mechanics, which helps you make much more informed trading decisions, avoids that emotional chasing.
That makes a lot of sense. Okay, so we get the what and the why. Now, the part everyone's probably waiting for, how do you actually use it? Let's talk strategy. Where does it get really interesting?
Right, practical application. Well, one of the most fundamental strategies is the classic MACD crossover.
The one you mentioned earlier.
Yep, the buy signal. MACD line crosses above the signal line, the sell signal. MACD line crosses below the signal line. Simple concept.
But there's a catch, I assume.
Always. The important context here is that this strategy works best, much best, in trending markets, when the price is clearly moving up or down.
Not sideways.
Definitely not sideways. Think about a 15-minute chart or maybe an hourly chart. If you see a nice breakout in price and then you get a MACD crossover confirming that direction, that can often lead to strong, sustained moves.
Okay, align it with the trend.
Crucial warning, though. Avoid it like the plague in choppy sideways markets. When the price is just bouncing around in a range, MACD will whip you back and forth. Tons of false signals.
Get seasick, you said.
Huh. Yeah, that's a good way to put it. I learned that the hard way early on. Tried to force MACD trades in a range-bound stock.
Yeah.
Got absolutely chopped up. Painful lesson. But vital. Know its limitations.
Ouch. Okay, noted. Avoid the chop. So crossovers are key, but you also called the histogram a potential secret weapon. How does that play out?
The histogram. Yeah, it's more subtle, but potentially very powerful. Its real strength isn't just seeing the bars get bigger, but catching when they start to shrink.
Fade.
Exactly. It shows you the strength of the current momentum, bars getting taller, momentum growing, obviously. But if they start getting shorter, even if they're still positive or negative, that can be an early warning sign.
A warning of what? A reversal?
Potentially, yes, or at least a pause or pullback. It suggests the buying or selling pressure is losing steam, getting exhausted. Savvy traders watch for this fading.
Before the lines even cross back.
Often, yes. They might see the histogram shrinking and decide to, say, tighten their stop loss or maybe take some profits off the table. It's an early heads up that the move might be running out of gas.
Wow, that's like getting a hint before the main signal. So it's about managing the trade proactively then.
Absolutely. It adds this layer of nuance. It's an early signal to prepare for a possible change. You wouldn't necessarily exit just based on the histogram fading, but you definitely pay closer attention, maybe look for confirmation from price action or other tools.
Okay, that makes sense. Proactive risk management. Now, speaking of really powerful signals, divergence. You hear that term a lot with MACD. What is it, and why is it considered so significant?
Divergence is, well, it's one of the strongest signals MACD can give you, potentially. It happens when the price of the asset is doing one thing, but the MACD indicator is doing the opposite.
Like they're disagreeing.
Exactly. The market's telling you one story with price, but the underlying momentum shown by MACD is whispering something different, maybe something truer.
Okay, how does that look?
There are two main types. First, bullish divergence. This is when the price makes a new lower low, but at the same time, the MACD indicator makes a higher low.
So price drops lower, but momentum doesn't drop as much.
Precisely. Even though the price fell further, the force of that downward move was weaker, according to MACD. This often signals that the downtrend is losing steam and a reversal to the upside might be coming.
Okay, I see. And the opposite for bearish.
Yep. Bearish divergence. Price makes a higher high, pushing up to new levels, but the MACD makes a lower high.
So less oomph on the new high.
You got it. Price is up, but the momentum behind that rise is fading. This is often a warning sign that the uptrend could be nearing exhaustion, and a reversal to the downside might be on the cards.
And finding these, that's a big deal.
It can be huge. Spotting divergence, especially on slightly longer time frames like a 1-hour or a 4-hour chart, can give you really high-quality entry points for swing trades, often catching turns near the bottom or top.
Okay, divergence is definitely something to watch for. Now, we've talked about MACD on its own, but you hinted earlier, it gets even better when combined with other tools, like supercharging it.
Absolutely. MACD is good, but like most indicators, it's rarely foolproof on its own. Combining it provides confirmation and helps filter out noise.
So what are some effective combinations?
Well, a popular one is LED plus RSI, Relative Strength Index. RSI measures overbought or oversold conditions. So imagine RSI is below 30, suggesting the asset is oversold. Then you get a bullish MACD crossover. That's a much stronger buy signal, right? You've got oversold confirmation plus momentum shifting up.
Okay, that makes sense. Layering the signals. What else?
How about MACD plus Supertrend? Supertrend is great for identifying the prevailing trend direction. The rule here is simple. Only take MACD crossover signals that align with the direction of the supertrend.
Ah, so if Supertrend says uptrend, you only look for MACD buy signals.
Exactly.
Yeah.
And ignore the sell signals. It acts as a fantastic trend filter, keeping you out of counter-trend trades, which are often lower probability.
Nice. Trend filtering is key.
Hmm.
Any others? Maybe with moving averages?
Definitely. MACD plus moving averages. You could use a longer-term MA, like the 50 period or even the 200 period EMA, to define the major trend.
The classic trend definition tools.
Right. So the rule could be only take MACD buy signals, MACD line crossing above signal line, if the price is above the 50 EMA or 200 EMA, and only take sell signals if the price is below them.
So the MA sets the overall market bias.
Precisely. What's really powerful about these combinations is they tackle that problem of false signals. By requiring confirmation from another, ideally complementary tool, you significantly increase the odds of the setup working out. It helps manage that potential information overload by layering insights logically.
Yeah, I can see how that adds confidence. But quick question. Does adding more indicators ever risk, like analysis paralysis, waiting for too many things to line up perfectly?
Oh, that's a huge risk, a very real trap. The key isn't just piling on indicators randomly.
Right.
It's about choosing a few tools that work well together, that complement each other's strengths and weaknesses. Maybe one for trend, one for momentum, one for overbought or oversold. The goal should always be clarity, making the decision easier, not harder.
Okay, choose your combo wisely. Don't just stack everything. Makes sense. Now, another great aspect you touched on is MACD's flexibility. It's not just for one type of trader, right?
Not at all. You can really tailor it to your style, whether you're in and out quickly intraday trading or holding for days or weeks swing trading.
So for intraday, short-term stuff.
For intraday, you're typically looking at lower time frame charts like the 5-minute or the 15-minute.
Okay.
And often, traders will use slightly tighter MACD settings instead of the classic 12-26-9, maybe something like 6-13-5.
To make it react even faster.
Exactly. More sensitive to those quick price fluctuations you see on lower time frames.
And for swing trading, holding longer.
For swing trading, you generally move up to higher time frame charts, the 1 hour, the 4 hour, maybe even the daily chart.
Right.
And for those, the classic MACD settings, 12-26-9, usually work quite well. They smooth things out a bit more, filtering out the noise you'd see on very short time frames.
So the core idea is just matching the tool to the job.
That's the principle, yeah. Match the indicator settings and the chart time frame to your specific trading style, your holding period, your goals.
It seems like there's a bit of an art to that, finding the right settings for your time frame. Do people often get that wrong? Like, use swing settings for day trading.
Oh, absolutely. That's a common mistake. Using slow swing trading settings like 12-26-9 on a 5-minute chart, the indicator will lag way too much. You'll likely miss the entries and exits entirely.
Too slow.
Yeah. And the flip side is true too. Using super fast, sensitive settings on a daily chart for a long-term swing trade, you'll probably get shaken out by noise constantly, way too many false signals.
So finding that sweet spot is key.
It really is. It takes a bit of testing and experience on your chosen time frame and market.
Okay, wow. We have covered a ton of ground here, a really comprehensive deep dive into MACD. I feel like anyone listening now has a solid foundation, understands the mechanics, the strategies.
Hopefully, yeah, from the basics to divergence and combinations.
Definitely. So maybe to wrap things up, any final key pro tips or advanced things people should keep in mind when using MACD?
Yeah, a few quick ones. First, always remember MACD is still fundamentally a lagging indicator. It's based on past prices, so don't rely on it in isolation. Always look for confirmation from price action itself, candlestick patterns, support resistance breaks, etc. Use MACD for context and confirmation, not as the sole trigger.
Price first, indicator second. Got it.
Second, really understand market regimes. We hammered this, but it's crucial. MACD shines in trends. It struggles badly in sideways, choppy ranges. Know when not to use it, or at least when to be extremely cautious.
Right, can avoid the chop.
And finally, those settings, 12-26-9, they're the standard, but they aren't necessarily magic for every single market or time frame. Don't be afraid to experiment a little, and crucially, backtest any changes you make. See if different settings actually improve performance for the specific thing you're trading and the time frame you're using.
Test, don't guess. Okay, great tips. Don't rely on it alone, avoid sideways markets, and test your settings.
That sums it up well. And building on that idea of trusting the logic, understanding why it works and its limitations, it leads to a broader point, perhaps.
Go on.
Well, think about it. What does truly understanding the underlying logic of a tool like MACD, rather than just, blindly following the signals it spits out, what does that deeper understanding allow you to achieve?
More confidence. Better decisions.
Yes, but maybe even beyond trading. Think about any complex system you encounter, whether it's in finance or technology or even just understanding the world around you. What power comes from digging in and understanding the mechanic, the why behind it, instead of just reacting to the surface level outputs?
That's a really interesting thought to end on. Moving beyond just following signals to truly understanding the system
hmm
leaves